This video and all other videos on this channel are for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest any capital unless you understand the risks and you are prepared to lose it all.
Alright, hello and welcome to Camel Finance. I'm your boy Camel and this is the weekend's deep dive. In case you're new, on the weekend I like to come back and re-examine the base case hypothesis, check for invalidations, and just make sure I can continue to have confidence in my position and in my posturing. So from the top, the expectation was at the lows, we were far too bearish. We would run to all-time highs, we would see rate cuts right around the top, and then we would move into a bear market and a global recession. Fast forward to today, and it seems like we are well and truly in that third and final blow-off top angle. Of course, we have already seen the onset of the Fed cutting cycle. So largely speaking, I expect this to continue for a little while before ultimately breaking down, and then I think I will be in that neighborhood where I'm ready to officially call tops and expect a bear market and a downturn and a global recession. It's also very interesting to me that we just so happen to be in the year where we would expect to see a 17-year cycle top. These have been very, very consistent and is indicative that we should see a top this year and that next year should probably be a red 12-month candle. For Bitcoin, the idea was fairly simple. It was that this cycle would top far sooner than anticipated. I was expecting an all-time high before the halving and ultimately a top before November of this year, qualifying its left translated. This remains to date the one component that has not quite played ball for me. We spent significantly longer in here consolidating than I was anticipating, and it seems to me like we're probably not going to get a left translated cycle top unless that was it right there, and instead we are setting up to see a top post-November now. However, I do still anticipate that this top will form significantly earlier than most people are expecting. I do not think we're going to get a normal cycle repeat where we top sort of late 2025. I still think we're probably going to top no later than about March of next year, and thus the implications are we would have to spend longer than the 12 months in a bear market decline that we are used to seeing for Bitcoin. For this idea to continue to be correct, for this idea to continue to play, we really need to see continuation of upside immediately here. If we don't get this kind of play out, then we are indeed not doing this Elliott wave fractal type deal we've got going on at the bottom. And if we were to continue to chop and range in here, something like this, then I think I'm going to start to move away from the earlier than expected top idea and instead start to move towards either this being the top or more likely, hopefully, a typical right translated normal and to be expected cycle for Bitcoin. The thing I really need to see for Bitcoin now is this needs to start really accelerating in the very, very near future. And if it does not, then I think it's about time that we start to entertain possibly a lot more chop into the end of the year and then ultimately a blast off, assuming, of course, that is not the ultimate top. One of the key components of this was that once the stock market finally tops and we move into a bear market and a global recession, there would be a deflationary component to this. And I have long been making the case that anything you do to the MT rate of change shows up in the CPI with a lag. We successfully managed to call this down, sideways wobble and down to correspond to down sideways whilst the market perceived this as sticky inflation, and I now believe we have started to see the resumption of the primary trend to the downside. This week we of course saw CPI come in and we got 2.4 for headline CPI. To visualize what this 2.4% looks like, okay, you can take a look at this right here and you can see quite clearly down, sideways, and now resuming to the downside. So I have a very difficult time moving away from this. I still continue to accept the base case hypothesis that the risk here is more disinflation before ultimately asset price deflation rather than this turning around and spiking to the upside. Of course, if what we see over the coming weeks and months is much more of a violent push to the upside, then I will be able to invalidate this as the idea. But all the while inflation continues to trend towards the downside, I continue to accept that everything is still going according to plan, at least pertaining to inflation. We also had the PPI come out on Friday and we had month over month come in at 0% month over month. 1.8% was a little bit above the consensus, but keep in mind they continuously revise the prior months in both data sets, and so with upward revisions we end up getting higher year over year results. But overall, you know, this is still going in the direction I want to see it. It's perhaps not as aggressive as I was expecting, but it is still trending in the direction I was expecting. Another core component of this is if we are indeed getting dangerously close now to seeing some major tops for the stock market and to the onset of a global recession, then we would expect to see labour market deterioration and unemployment start to spike. And I continue to make the case that that is what is unfolding right beneath our eyes. You can see the US employee non-farm payrolls temporary health services typically leads and is spiking up towards recessionary levels similar to the prior times we saw this. This week as well, we also saw initial claims and continued claims come in significantly hotter than expected. So again, I make the case that whilst investors are very good at looking right beneath their noses and taking the 4.1 unemployment rate data at face value, as I showed in multiple videos over the past week or two, that real number is actually much more likely to be around 4.5%, which continues to tell us that this thing is starting to accelerate to the upside, and this is being confirmed by initial and continued claims. And to really visualize the initial jobless claims data, okay, on the left here is 2007. You can see 742 days to rise 29%. Fast forward to today, in the same 742-day window, we have risen 38%, which is significantly worse than back in 2007 going into 2008, where of course we had a global financial crisis. This to me says alarm bells are ringing. I think we are possibly no more than 1 or 2 more months of this kind of data to continue before everyone is going to start to work out we are indeed in a global recession. And once the majority of the market realizes this, it typically manifests as those third and final angles, breaking down in the stock market, panic selling in stocks, and we will most likely be entering a bear market. So wholly speaking, the stock market is seemingly putting in its blow off top. We have indeed managed to call the rate cuts on time. Inflation appears to be moving in the right direction, and we've got labour market deterioration showing up right on schedule. And now here's the critical part starting to accelerate right as those stock markets are putting in their third and final blow off top angles. Following all of this, we ended up closing the week out with around a 90% probability that we will be seeing a 25 basis point cut at November's meeting. I continue to make the case that we are going to see rates reprice in favour of additional rate cuts. And one of the reasons I'm so confident about this is right here, we've got the US 2-year yield minus the Fed funds rate. Even after the 50 basis points cut and even after the big counter trend rally that we have seen in the yields, we are almost 120 basis points behind the curve. Okay, the difference between the 2-year yield and the Fed funds rate is around 120 basis points. Now, to put this in context, somewhere around here was where the dot-com bubble burst, okay? And you can see we got a push down to a low of something like 120 basis points behind the curve, and then the Fed was forced to go on a very, very aggressive cutting cycle to catch back up. Back in the GFC, okay, keep in mind, the market topped somewhere around here. We saw the Fed reach an ultimate low of around 190 basis points behind the curve before, of course, it was forced, therefore, to go on a very, very aggressive cutting cycle. And so with that as the context, okay, we have not yet topped. We made a low of around 170, 180 basis points behind the curve. And like I said, even with a 50 basis point cut, even with the yields putting in quite a significant counter trend rally, okay, this is the 10-year yield, the 2-year is around the same, of course. We saw yields up about 14%. If I pull up the 2-year yield, okay, this is not nothing. This is a significant rally. This is 17%. So the big question is the bond market in aggregate going to be okay with the Fed remaining around 120 basis points behind the curve? Or is this just a counter trend bounce? Did we just reject a resistance, and are we about to continue to see yields come off? If so, that will continue to put pressure on the Fed to be forced to start cutting more aggressively in order to get this spread to normalize. So I know there's a sea of investors out there that say we're going to see pauses, we're going to see hikes, right? But again, I sit here and say, tell that to the bond market. The bond market in aggregate does not believe you. The bond market is going to continue to price additional cuts. I'm pretty certain we are going to see this thing reject at resistance. Same deal with the 10-year yield and move significantly to the downside. And then the Fed is likely going to have to start to completely rule out a pause on any hikes. And this is most probably going to start to reprice towards 50 towards the end of the year. So wholly speaking, I am more than confident at this current moment in time in standing with the base case hypothesis, and thus I continue to be long and bearish, which is a very strange posture to hold. But at the end of the day, it's not really for me to say, well, let's be all doom and gloom. Let's be all scared of the market. If the market is going to keep making higher highs and higher lows, then I want to be on board. We are currently rocking with another S&P 500 position. The big thing about this weekly close, and I've been talking about this all week, is we have now got a weekly candle close at new all-time highs. Okay, if we put this into a weekly time frame, there you go. So I think it is pretty safe to say, I don't think we're doing this distribution top. Okay, now of course, I will pivot my stance if on Monday we open up with a big red 200-point downside candle. Okay, then of course we have to put this back on the table. But for now, at least, it seems like we have indeed seen the price action that we needed to see in order to move away from this. I don't think this is in play anymore. I think we have more than confirmed a new daily cycle. And I think there is space for this thing to continue to run to the upside. This is the third and final angle. Usually when these things break down, what we see is something like this. Okay, a breakdown, we get a grind along the second angle, and then the first angle from down here becomes the minimum target. So I am more than happy to stay long and strong until we get third and final angle breakdowns, but the moment this thing breaks down, I will be exiting the market, I will be flipping short, and I will be moving from super duper uber long across the board to capital preservation mode. The Nasdaq also seems to have confirmed a new cycle, so happy days there. And the Dow Jones, again, look at this for a weekly close, okay? Look at this for a massive, strong uptrend, a big third and final angle. And when we zoom out, of course, okay, it's starting to look very, very parabolic. The market can continue to rip higher and probably go a lot higher than most people are anticipating. But in terms of time, we are getting very, very late. These third and final angles, remember, last an average of 2 to 8 weeks, and a very, very hyperextended one might run as much as 12. So given that we are already 9 weeks in for the Dow Jones, okay, this thing is probably going to be topping in the next few weeks, okay? That would just be normal and typical and to be expected. And since that is most probably the case, okay, then would we not expect to see the VIX come down, make one final low, and then look to see a good breakout here and probably a spike to new all-time highs? That's what I'm thinking is going to unfold. That's why I'm still hunting a nice lower price so that I can get some hedges on, and I want to be doing this ahead of the next daily cycle topping because I want to be hedged before the thing starts to break down and before therefore the VIX starts to spike. The VIX usually leads by a couple of days. By the time this thing has made a move down and then started to creep up, alarm bells should be ringing in my humble opinion, and time to be defensive will become order of the day. I also think the Russell 2K is finally going to move up now. I think this is probably the cycle low here, and I think we are finally going to see this thing start to rip higher. Again, I really don't expect this to last very long. I think this is probably a number of weeks, if at the most, and then we're going to see this thing come tumbling down. As ever, we'll keep taking it one day at a time, and if the market shows me something different, okay, if what comes next is this for many years to come, then we'll just stay long and strong. Gold very nearly confirming a daily cycle low in here now, right in the expected timing window after getting that expected 2 drives pattern. So this is just textbook cycles doing cycle things. We haven't yet confirmed with a trend line break, but I would imagine that's coming on Monday, and therefore there is an opportunity for me to be long here. Although keep in mind what we are expecting here is a left translated daily cycle, so we're probably already on day 3 as of Monday, and we would therefore expect this thing to top day 9 or day 10. And if Bob Lucas is right, okay, I think there's a good chance we're going to make a new higher high and then roll over, which is why I'm happy to play this bounce. But if Bob Lucas is right, then we're not even going to get a new high. We're going to get a lower high in here, something like this, down into that weekly cycle. So this is probably not the smartest trade in the world. Probably makes more sense to be looking for some kind of pop and a short entry once we found a swing high on around day 9 or day 10. Or probably an even better way to play this would be to just wait for that weekly cycle low to show up and then look to get behind a weekly cycle. I added a silver derivative position in the members section late this week, so I am positioned just in case we do see a face melting rip here. I don't necessarily need to play gold as well. But as ever, we'll keep taking it one day at a time and see if I like the setup on the day. And of course, Bitcoin, right? I mean, the yellow squiggle so far, doing yellow squiggle things. So far, this seems to be okay. And I see a lot of nervousness out there. I see a lot of big accounts calling for a big plunge to 40k. Maybe they get it, right? But until the market shows me that, then I continue to stand with this. I'm pretty sure we just found the half cycle low in here, something like day 34. You'd normally expect to see it between day 27 and day 33. Day 34, close enough for me. And all we really need to see now, remember, is a continuation, a new higher high, and for this yellow squiggle to be, roughly speaking, followed through with, and we will be able to say this was indeed a cycle low inversion. This is most probably the weekly cycle low. Bob's count of the weekly cycle low being here is probably not what's in play. And of course, the biggest thing about this is if the yellow squiggle continues to play out, we also get to move away from the idea that we've got to chop around all the way into the end of the year before we can look to move higher. Any kind of sideways chop in here, and we will probably have to say this is wrong, and Bob Lucas's weekly cycle count from back here with the expectation that we range into the end of the year is probably correct. So as ever, it's not about being right or wrong, okay? It's about understanding what the market is doing, having some expectations and being willing to adjust once the market proves to us what exactly is going on. So far though, looking pretty good to me. And then of course the big thing is this dollar breakout for real, okay? Is this dollar starting to price in that third and final angle violation? Are we going to start to see dollar continue to be bid here? And is this going to start to accelerate in a more deflationary look as and when those stock markets and risk assets violate their third and final blow off top angles, okay? If so, then something like this is probably coming. We probably did just find a 3-year cycle low in here, which means we can scratch this one off and this one. It also means we're probably not going to get that move down to the 90s like a lot of people think. But if you're still in the camp of people that says this is a fake breakout, this is not in play, then now would be about the time to see a left translated daily cycle and a move down into the cycle low, okay? It would look something like this. This would be a day 9 or 10 high, and move down into that cycle low, then you'd look for another left translation with a failure. So That path is still on the table, but similarly with Bitcoin, it's really now or never for this idea, okay? If this continues up into a right translated cycle, then it's only reasonable to expect another right translated daily cycle after that. And then, of course, it goes back to this deflationary bust type squiggle. And like I kind of touched on already, if we are not going to be in some weird environment where we have to put pauses and rate hikes on the table, okay, if we are going to see yields come off and roll over, then again, that will all make perfect sense because we are expecting these third angles to break down in the not too distant future. We'd expect to see the bond market reprice the yield significantly lower because they know that the Fed is going to have to be forced to start panic cutting. So watching this week to see if the yields come off, watching this week to see if the dollar left translates in its daily cycle, and continuing to rock long and strong with the positions we've got until the point where we lose third and final angles. If you're not subscribed, make sure you subscribe, follow along so that you can see this hedge get put on in real time. This is called out weeks in advance, okay? They've been patiently stalking this thing, waiting for this thing to set up. So if you want to see me get a hedge on for what I believe will be one of the trades of the decade, then please do subscribe. The reason I say trade of the decade is I think we're going to see brand new all-time highs. So we're going to be looking at a few points of risk relative to 100 odd points of reward here. So if you want to see me do that in real time, call it out and all of that good stuff, then like I said, hit that subscribe button, turn the notifications on. If you're a level 3 member, look out for the members only video for you. I think we got some brand new positions to be getting behind on Monday. Other than that, I hope you're all doing well in life. I hope you have a fantastic weekend. And until next time, take care from me. All the best. Cheers. Bye.
Camel Finance, he's the man to see. Rocking the markets with his contrarian spree. Trades like a pro, no fear, no shame. Sticking to his guns in his money game. He's a badass, oh yes indeed. Camel Finance got the markets key. Taking us normies on a bump.